The United States wakes up divided, and the rest of the world watches carefully. The country that for decades stood as the global political and economic axis is now facing the longest government shutdown in its modern history. Dozens of federal agencies are paralyzed, hundreds of thousands of employees go unpaid, and Congress still cannot approve a budget. Meanwhile, air traffic collapses, thousands of flights cancelled, control towers working at minimum capacity. And the inevitable question arises, can a nation sustain its economy without a functioning government? Economic data stops flowing, but corporations are already speaking loud and clear. In just 2 months, more than 250,000 jobs have been lost. Layoffs are concentrated in technology, logistics, and retail. Amazon, JP Morgan, UPS, and Target are cutting staff, claiming restructuring and automation transition. Artificial intelligence is not the future, it's the present, and it's replacing human labor faster than society can adapt. Every algorithm that learns replaces several workers. Every dollar invested in automation is a dollar taken away from wages. Jamie Dimon, CEO of JP Morgan, put it bluntly, in the future, we'll work 3 days a week. That comes from the head of one of the world's largest banks. So the real question is, what happens to those who won't be part of the technological elite? Markets show confusion. The S&P 500 fluctuates with no clear direction, the Nasdaq 100 barely reacts, and Bitcoin once again becomes a psychological refuge. But while the indices move slightly, the foundations of the economy are shifting, and not in a good way. The Federal Reserve has started buying U.S. Treasury bonds again to keep the system liquid. In a single session, it purchased $20 billion in 3-year bonds without any public announcement. This kind of operation, a stealth quantitative easing, is normally reserved for crisis situations. When it's used outside of them, it creates something dangerous, the prelude to a bubble. The government's total public debt now stands at roughly $36,600 billion, and the annual cost of interest has surpassed $1 trillion. Can an economy survive by creating money to buy its own debt? Historically, no. When the issuer of a currency becomes its main buyer, confidence in that currency erodes. The Fed's balance sheet is expanding again. Officially, it denies printing money to finance the deficit, but the effect is the same: more liquidity, more inflationary pressure. Investor Ray Dalio has described this cycle many times: growth, then overborrowing, then inflation, and finally correction. The United States appears to be deep in that penultimate stage. Household debt now reaches $18,590 billion. Inflation remains high, real wages stagnate, and borrowing costs rise. How long can this dynamic continue before something breaks? When the Fed finally slams on the brakes, it may already be too late.